Growth stock investing versus dividend investing. Which one is better? Now we need to get a few things straight right off the bat, okay? There is no one correct way to invest. Every investor's situation is different, okay? I, for example, am a 22-year-old, okay? With next to zero financial worries, okay? With zero income at this stage, I could survive for years. I also have a very high risk tolerance, and I'm also in a very unique job that is YouTube, where your income is essentially exponential. You don't get a small raise every year or two. Your money in general will go up every month. And this offers a rather strange situation where my portfolio should also be growing exponentially. When I first started investing, which is just less than half a year ago, I haven't been investing very long whatsoever. My initial plan was to invest $150 a week because that's what I could afford. In the last 7 days, I've put over $2,000 into the market, largely because of YouTube and because of my increased income. With being young and being in this unique position, I want growth, okay? I want to take advantage of the situation that I am in. I also want to be in a financial position to retire very early on. I mean, before my 30s, I would absolutely love to be in that safe of a financial position. Now, I don't plan on retiring by then, but I would like to have the ability to do so safely. I want to invest my money rather aggressively early on so that I can be in that position as soon as possible. That is why I personally am so focused on growth stocks as of right now. Now, with that being said, I want to retire off of a dividend-based portfolio and real estate. That is my long-term plan. But in order to get there as quickly as possible, if I'm just to invest in these relatively slow-growing dividend-paying companies, it's going to take a little bit longer. The point that I'm really trying to make here, okay, is that every single investor is in a different position, financially, everything. What works for one person, aka me, may not work for you or may not suit your financial needs, and that's why I so heavily preach on this channel that you need to be able to form your own opinions and do your own research. You can't just copy me or anybody else because we could have completely, and I mean completely different goals and objectives. But anyway, today what I really want to do is go through the pros and cons of both growth investing and dividend investing, compare the two, and ultimately explain why I am now so heavily involved in all of these growth stocks. So right before we get into the juicy information, can I please ask you to smash a like on this video, as it genuinely helps me and the channel out so much. I would really appreciate it, people. We are less than 200 subscribers away from 20,000, and that is absolutely mind-blowing to me. So I just want to say thank you all so much. It is insane. And as you probably know at this stage, when we hit 20,000, this official Not a Financial Advisor merch is launching, and I'm so excited for that. So please do make sure to hit that juicy red subscribe button if you're new around here. Join the family. And I'm really interested in hearing from you guys in this one. Please do drop me a comment down below. Let me know what kind of investor you are. You know, if you're predominantly growth or dividend, if you're a mixture of the two, if you're in bonds, real estate, whatever it is, I'm really interested. So with that being said, guys, let's get into it. Now, this was actually a pretty cool article I found, and it's a nice place for us to start, okay? Why it's better to invest in growth stocks over dividend stocks for younger investors. And it starts off like this. Dividend stock investing is a great source of passive income, and I 100% and completely and utterly agree. I do own some dividend paying companies, and ultimately the end goal is to have a big dividend paying portfolio. The problem is, with dividend yields relatively low at 2 to 3%, a lot of people aim for 4%, you need a lot of capital to generate any sort of meaningful income. Even if you have a $500,000 dividend stock portfolio yielding 3%, that's only $15,000 a year. And I mean, $15,000 a year is a decent bit of money, but you need $500,000 to get to that stage, which simply put, a lot of people don't have. Now, I know this doesn't include the fact that these dividend companies will more than likely grow over time as well. On average, people tend to look for about 10 to 15% on a good dividend paying company. But in straight raw dividend money, $15,000 what you're looking off of a $500,000 investment every single year. 3%, not great. Now, this is one of the things about dividend companies, okay, that I didn't really appreciate enough when I first started investing. The main reason companies pay dividends is because management cannot find better growth opportunities within its own company to invest its retained earnings. Now, this most certainly is not always the case. Apple, for example, they have pretty much a 1% dividend yield right now, but it's because they have such a strong balance sheet, and it's only 1%. It's a very small percentage. But if you look at a lot of the dividend paying companies, this is true. And they use the example of Tesla, a company who doesn't pay dividends, and it's quite clear to see why, because they need to reinvest everything they have in order to stay ahead technologically technologically and stay ahead of the competition to offer the best EV service possible. If Tesla was attempting to pay out any sort of a decent dividend, their growth would slow down so quickly. Then we have a look at a company like AT&T, a very popular dividend paying company, one that I do actually own, and it is one of my favorite dividend paying companies, okay? They have a very high dividend. Right now, it is just under 7%, which is a very tasty dividend. The opportunity for accelerated growth in a company like AT&T is low, but the cash flow generation is high. So since they have a lot of money lying around, they don't have much to reinvest into, they just reward their shareholders, which is absolutely fine. And you know, for dividend investors, that's exactly what we want to see. But do understand that a lot of the time, a company pays dividends because there is not much room for growth. That's why you don't see Amazon, Facebook, Tesla, all of these big, massive, high growth companies paying dividends. So again, for me, somebody who wants to aggressively invest and aggressively see their capital grow, dividend paying companies, they don't make the most sense with the amount of money I have readily available to invest. Even if you do have $2,000 to put into, say, dividend paying companies, even at a 4% dividend yield, at the end of the year, you are looking at what, $80? Now, let's focus on growth stocks, okay? Because the thing to understand about growth stocks is generally there is a lot more risk that goes alongside them. If there wasn't, then everybody would just invest in growth stocks, okay? Why would you invest in the one that has a lower return? Because it also has a lower risk. Right now, I'm going to show you my 5 biggest holdings that I currently have in my portfolio, okay? My biggest holding as of right now is Workhorse, okay? Now this one's a little bit different because it is still a relatively new company. But even for Workhorse, on the 5-year chart, up over 500%. Now, with that being said, literally most of that came in the last couple of months. It's not a great example, but it is a great example of exactly what a growth stock is. It's a low market cap company, okay? 1.2 billion as of right now. It was down around 300-400 million for a very long time. They're penetrating into this emerging, fast growing market that is electric vehicles, and they have the potential to be at the top of their subsector, last mile delivery vehicles. We look at Apple stock, one absolutely everybody is going to know, okay? Up 281% in 5 years. A lot of people try to argue that the FANG stocks are no longer growth stocks. They can't be, their market caps are too big, etc, etc. No, it's just completely untrue. The same people would have been saying that 5 years ago, or even 2 years ago, okay? Let's say back in 2018, it's up over 160% since then. Then we have Amazon, okay? 5-year chart, up 513%. A dividend company that would have paid a 4% dividend and gone up 10% every year wouldn't have even been a fifth of that. Facebook on the 5-year, not quite as big, but still 164%. Very nice growth. And then I don't even need to introduce you to this fifth company, but again, over 500% growth in 5 years, people. That is why I like growth stocks, because the return on investment can be absolutely insane. A lot of people will argue, especially with the likes of Tesla, Facebook, Apple, etc., that they aren't growth stocks anymore. I would have to 100% completely and utterly disagree. The same people would say that Workhorse is too risky to get involved in right now. It's too risky. The same people would have said that about Apple, Amazon, Facebook 5 years ago, maybe 10 years ago, and look what's happened. Now with growth stocks, a lot of them can go wrong, you know. A lot of time you can lose 20-30% in the span of a year, 2 years, 3 years, whatever it is. But if you get considerably more right than you get wrong, you are still going to be making a whole lot more money than a safe dividend portfolio. So a little article here about the pros and cons of growth stocks, okay? Pros. A single investment in a big winner can make you rich. It's that simple. Let me bring you guys to Apple stock yet again, okay? 40 years ago, the 12th of December 1980. If you invested 40 years ago, you would be up 86,000%. You just have to get into one of these companies and you are literally set for life. When you see that Apple has made 86,000%, do you think that somebody's going to be worried if they maybe made 2 or 3 poor decisions in regards to growth stocks and maybe they lost 100% total? Well, in Apple they made 86,000%. I wouldn't be too upset about the losers. Timing your investment in a growth stock is not critically important if you can buy it early enough in the growth phase, as invariably a poorly timed purchase can be salvaged by meteoric growth for a sustained period of time. This is again why I don't like trying to time the market, particularly with these growth stocks. Workhorse is a great example of this right now. 5-day chart. I mean, you guys are already aware of what happened. We shot up in value over 20% after the SPAC of Lordstown Motors was revealed. Since then, boom, it's come flying back down, over 10%. If I bought at $19, would I be panic selling? No, it'd be absolutely fine to me. Workhorse to me is the absolute definition of an early stage growth stock. I mean, Apple, when you take all of the stock splits into account, okay, let's say it debuted at 51 cents. Does that mean that when you bought at 175, Oh, it was terrible. Considering the fact that it went all the way down to 121 only, a few months later, it still would have given you back 28,000%. I think a lot of people mistakenly associate growth stocks with short-term investing. I really don't think it is. If you follow this channel, you know I speak about Workhorse a lot, okay? I'm heavily invested. It literally is my biggest investment right now. And when this happened here, okay, when this little 20% jump happened, a lot of people asked me, was I taking profits? No, because I genuinely believe this has so, and I mean so much higher to go. A lot of people asked me, was I worried when it started coming down here? No, not in the slightest. I didn't lock in any profits. I didn't split my position. I bought more. Though I also understand that this could be, maybe a $4 or $5 stock if everything in the world goes wrong for them. Yes, that is growth stocks for you people. It is not the safe option by any means whatsoever. And then they are fun to own as they consistently beat earnings estimates and their stock price are generally on a staircase like uptrend. Everyone likes good news and these companies deliver plenty of it. Now this to me can be both a pro and a con, okay? They move quickly. Again, look at Workhorse for an example. Some news that came out in regards to Lordstown Motors made them shoot up over 20% and just as quick they're back down 10%. If you want to be a growth stock investor and you really want to get into companies early on, you better be ready to hold true news. Because if you're not, it is not going to be a fun time for you. But this as well, everyone likes good news and these companies deliver plenty of it. Again, in regards to Workhorse, there is literally news every single week, every few days. It is exciting to keep up to date with this company. I would much rather be keeping up to date with Workhorse than Procter & Gamble, Now, cons, there are never dividends paid by these companies in their early fast growth stages. Again, to me, it's not even really a con. Like, if they were to pay dividends, they would grow less, your return would be less. You generally are going to pay a high multiple of earnings and feel like you are overpaying. Very, very true. And again, something that always gets brought up in the comment section and it grinds me the wrong way. This is growth stock investing. This is what it is, people. They are rarely cheap. Very true in a traditional sense. If you don't have the risk tolerance, okay, if you can't afford to lose some of what you're investing, stay away, be the safe player. Go into dividend companies early. They're still going to give you a nice return as time goes on. But if you are like me, you have the risk tolerance and you want aggressive growth stocks make so much sense. Now, going back to dividend investing briefly, okay, we're going to go on to Investopedia, fantastic website. The 3 biggest misconceptions of dividend stocks, okay, and the first one is massive. It's absolutely massive. High yield is king. I always get comments from people asking me to check out these really high yield dividend companies, okay? And there's a reason that dividend investors predominantly invest in dividend paying companies that give a 3 to 4% yield, okay? It's because these high yield companies in general don't pay off. On March 17, 2018, Corpus Entertainment is the top dividend yield company with a dividend yield of 26.9%. Wow, just for owning this company, you can get back 26.9% every single year. It has a 10-year annualized total return of negative 1.81% and a 3-year annualized total return of negative 18.54%. A high dividend yield does not make it a good investment by any means whatsoever. Regardless of whether you're investing in a dividend paying company or a growth stock, invest in the company, okay? The company, not the dividend yield, not anything else. I've spoke about this in previous videos, but I like investing in companies, okay? That's why paying a premium, paying a high, PE ratio, etc. on these relatively up-and-coming growth stocks or even some dividend-paying companies doesn't bother me. I invest in companies, I invest in management teams, I invest in prospects. It may not be the most traditional form of investing, but it is what I like to do. Now, dividend stocks are always boring, okay? I don't even think many people think this. Have a look at somebody like Altria, a company I really like, very high dividend yield, does have some growth prospects, somewhat conflicting information, but yeah, dividend stocks definitely aren't always boring. But the main thing I want to get to is the fact that dividend stocks aren't always safe by any means whatsoever, people. You can't just blindly invest in every single dividend company and expect returns. It depends on the underlying company, okay? Please understand that these companies are not safe just because they pay a dividend. This is something I see so often. Dividend investing is not safe unless you pick the right companies. Let's have a look at Johnson & Johnson, for example, okay? One of the most popular dividend paying companies out there. I think everybody can agree on that. On the yearly chart, this company is up 13.48%, quite good. When the crash happened, okay, this company dropped 27.61%, people. And you can see on the 5-year chart, up 50.13%. That's pretty much exactly what dividend investors look for, that 10%. But if you were one of the people who bought here at the peaks in 2018, it's only up 0.71%. 8% with a 2.72% dividend yield. They are not safe and they are not easy money. Let me put it that way, people. This is deemed to be one of the safest companies in the world, and there genuinely are people who have been holding this company for 2 years who have made less than 5-6%. Now look guys, as always on this channel, I don't want to push an agenda on anybody, okay? I'm just giving my thoughts and opinions, and I want you all to be able to think for yourselves. As I have said numerous times in this video, growth stocks are the much higher risk option. I fully accept the fact that I will have some losers. I'll more than likely have some companies that I could be holding for 1, 2, 3 years that will be in the red. I'll more than likely have some companies that ultimately I will take a loss on of 20-30+%. It is the way it goes. But if you get one company that can give you back 10,000+% in the span of 20, 30, 40 years, it's nothing. And again, I want you all to be aware that even though now I am predominantly focused on growth, it is with the ultimate intention of having a dividend based portfolio. I think that growth stocks are very good for building wealth, but I do think that dividend stocks are better for, maintaining it, slowly but surely growing it, retiring early. Growth stocks are my means to building a dividend portfolio essentially. It really does depend what stage of life you are at and what you want to be getting out of your investments, okay? So that is why it's so important to understand your goals and form your own opinions on everything you decide to invest in. Whether it's bonds, stocks, real estate, or anything in between, you decide to pull the trigger, you decide to invest, not anybody else. But anyway guys, that is the video on why I personally am so heavily focused on growth stocks as of this moment in time. Now guys, if you have watched until the end, hopefully you got some entertainment and some value from this video, and genuinely from the bottom of my heart, I appreciate you so much for sticking around. Yet again, as of recording this, less than 200 subs away from 20,000. When I started investing, when I started this channel, no way did I ever see this happening so quickly. Genuinely, it is nuts how fast everything's happening. I really do appreciate you all so much from the bottom of my heart. If you are new around here and you did enjoy, please hit that juicy red button. Help me get to that 20,000 mark. I am not going to slow down, people. We are only speeding up on this channel. And one more time, I really do want you all to go out there, form your own thoughts and opinions, decide what you invest in without me or anybody else having any major influence. It is all on you. Anyway guys, thank you so much for being here. I hope you have an absolutely fantastic day. I will see you for the next video. Peace.